There's a guy named Rob Edel that's done some great studies on this. He's an analyst from the States. And the number in 99 was so far out of whack, even with 1929, that there's never been another number like it. So it was an outlier that nobody had ever seen before in terms of price-earnings ratios. He would make the argument probably today that if you were simply buying the market, and he would argue that that would be a big mistake, if you're buying the index, that the problem is that based on the current PE ratio today, we're still in the relatively high valuation zone when you look at PE ratios over, say, a century. So we're not in bargain territory by any stretch of the imagination. We're not necessarily particularly expensive, but we're not in bargain territory either. Now, he believes in fundamental investing, and he actually has created indexes to buy companies based more on whether it's tangible book value per share or their dividend yields or their growth in dividend income, whatever it might be. And he uses that as a methodology to say that would be a better way to go. So I have to admit, we're pretty well the same in that we're not index investors. So it's not that we don't care where the stock market's going, but when we make an investment decision, we're actually looking to just buy a company. And so the dividend yield on our equity pool is about 60% higher than the dividend yield on both the TSX and the S&P 500. So we're sort of disconnected from the value proposition you're talking about, Larry. We just try to, the market's going to do what the market's going to do. And generally speaking, we don't have more than 35% of our clients' money at any one time in equities in the first place. And when we do have them in equities, we're still looking for that cash flow payout. So we're not really looking at the market PE. We're looking what's our PE that we're focused on, right? So
yeah, no, but I think the observation that big overvaluation that we saw 10 years ago has been dramatically diminished. And it depends on whether you look at PE multiples on a trailing basis, on a forward basis to see how expensive the market is, or if you use a normalized 10-year average earnings, which I know Robert Shiller does, and when he looks at that, he would argue the market still looks fairly expensive. The other thing to consider, you can look at a long-term average, and let's say it's about 15, 16 times earnings, but the PE multiple will change depending on whether you're in a inflationary or a sort of a deflationary time period. So if you are entering an inflationary time period, the average PE multiple would contract and would move lower. And if that's the case, well then I would maintain the market still looks expensive. But on a long-term basis, not in an inflationary environment, probably around fair value. So now what you're doing is you're relying on earnings growth. So when we were to look what we would see as a potential return in equities right now, we're not assuming any multiple expansion. It's all earnings growth and dividend growth, which is, as John says, the bigger deal for us.